Good morning or afternoon, wherever you may be. I'm just going to do hopefully a real quick video, a total market overview of what's going on in the market. Of course, everybody should know or be aware of we are in the final stretch of an election. Um, Historically, I was unable to really find anything of significance to really base any of my judgments off of, but what I am seeing on a lot of the major sectors of the overall S&P 500 is at least a little bit concerning. First up here, I'm just going to go through all of these uh, in order of their weighting in the S&P 500. So first of all, here is technology. This is the XLK. As we can see here, we're at extreme highs, levels we really haven't ever seen before. Valuations are stretched again, which is the same thing I was saying at the end of last year. We did sell off, although it was in addition to what was going on with COVID. So that really exacerbated the selling, but right now we're again at very stretched valuations, even with the move to a lot of digital communications and all that sort of stuff. Technology is very stretched. So right here is XLK, is 28% of the overall S&P 500. This last week here in August was a huge wide range bar. Not necessarily a signal of a top, however, to me it implies that it's going to be at the very least range bound in between this 127 to, we'll call it all the way down here to 110 area. Now XLK can be flipped with the Qs, same thing. I just use the XLK because it's staying in the S&P realm of things. So basically looks like a weekly top here. We'll see what happens with that going forward. Now on the daily time frame, if I zoom in a little bit, I'm not going to go into the daily time frame on all of these, but it is a potential cup and handle, whereas this looks like a little bit of a bull flag. If this is a cup and handle, then the measured move would be from approximately 110 up here to the rim, about a 15-point measured move from wherever the breakout starts to occur. So if this is the low, we'll call the measured move up to about 133. So that's technology. Next up here is XLV. This is the healthcare ETF, represents about 14% of the overall S&P 500. Has been in a very nice channel here. Once it broke down below it because of COVID, quickly regained it, and we're now pressing highs again. Now again, this is another sector where a lot of the individual names are trading at stretched valuations. So it's time to be a little bit cautious as far as getting too aggressive with some long positions. Now I am holding a lot of swing positions, which if the market does start to roll over, I will systematically close them out and simply wait for another bottom. There are going to be some bears calling for an overall top, a crash in the market because of elections or whatever. Again, couldn't find a significant correlation to what happens in the final stretch of an election year for the overall stock market. So we'll see what happens going forward. Now next up here is XLY. This is the consumer discretionary ETF, represents approximately 11.6% of the overall S&P 500. Again, this is another one that's extremely stretched, very high valuations again. And although it did put in a new high, the consumer discretionary does look like a decent market. But this one also includes Amazon, Home Depot, McDonald's, Nike. So a lot of these names that have been performing very, very well have significantly beat on their recent earnings calls and guided higher. At least some of them have guided higher. So this is a decent sector to be in that it has made a new recent high. But again, stretched valuation, just have to simply be careful. Next up here is the communications ETF, Xlc. And this is comprised of Facebook, Google, Verizon, Netflix, Disney, Comcast, and AT&T. Now this one has not made a new high. It's actually down below what I identified in virtually every one of these sectors. Is this wide range bar. It's now below that low. So looking like this may be one of the first ones to continue to roll over. Now there are some weaker sectors I'll get to momentarily, but this one comprises 10.6% of the overall S&P 500 and looks like it has topped, maybe not permanently, but at least for the time being. I wouldn't expect it to get back up to new all-time highs unless something significantly changes. So we'll see what happens going on with that. Next up here is XLF. This sector is actually extremely undervalued, but it seems like there's a lot of fear in the market, a lot of unknowns as far as how many loans are going to be defaulted, what kind of losses the banks are going to see, because as you can see, didn't even come close to getting up to these recent all-time highs. Now, in my opinion, that's all this is there's a lot of fear simply because participants are afraid of something like this happening, which was as a result of the housing crisis. Now, there are going to be loans that default. There are going to be losses in some of the banks. But from the statistics and the notes we've been getting out of the Fed and the banks themselves, they have hopefully adequately prepared themselves for that coming hit, so to speak. So XLF here represents 9.6%, which is actually lower than it was the last time I did one of these overall market videos. But I do still like the banks as far as their fundamental valuations. It's just there's fear and uncertainty in this sector, so I just have to be cautious about it. Now on to industrials, represents almost 8.5% of the overall SP 500. Has just now tested this gap down level. So if it can get back up through there, I'm not saying it's strong enough to lift the overall market, but that would at least be a sector to keep in mind. But again, being this close to all-time highs, there's not much meat left on the bone. Going forward, industrials are not a sector that I closely follow, so I can't really say much about individual names, but it does look like, obviously, it hasn't made a new high, and there are other stronger sectors out there. But again, the whole theme of this video is to say that most everything is at or failing at all-time highs, and it looks like there's more downside risk than there is upside. So just time to be cautious is all I'm saying. Next up here is consumer staples. This represents just under 7% of the overall S&P 500. Again, another sector that failed to make a new high. Could potentially be looking at a bull flag here in consumer staples. Now, consumer staples is made up of Procter & Gamble, Walmart, Pepsi, Coke, Costco, Philip Morris, Mondelez, and pretty much consumables. So this sector may be quote unquote safe, but it's not necessarily something that's poised for a lot more growth, especially from these levels. So again, this is a sector that's just time to be cautious. As simple as that. Next up here are utilities. Utilities is actually the only sector on here that looks like it may be bullish, may be continuing higher. Now, is money going into it as a defensive play? That's what it looks like. Now, utilities only make up 3% of the overall market, so that's definitely not going to be enough to lift the S&P, not even, in my opinion, to stabilize the S&P 500 from a significant drop, but it may be a nice place to park some capital. We'll see what happens with this one going forward. XLU is, I'm not familiar with any of these names, so I'm not even going to go over them, but it is at least what looks like to me one of the stronger sectors despite not making it up to all-time highs. It does look like it's breaking out of this multi-month base here. Oh crap, this is actually on the monthly time frame. Let me go down to the weekly. It's a little bit easier to see. Once it broke above this base around 62, as long as it holds above 63-ish, looks like utilities are going to continue to stabilize, but again, it's so small of a portion of the overall market, it's not significant enough to really stabilize it, in my opinion. Next up here is XME. This is the mining and materials or metals. Just the overall weak sector. Now, in the long term of things, on the monthly time frame, looks like it may be a very long-term double bottom. If that is the case, maybe this will be a sector to look at. But again, this is another very small portion of the market. It's 2.6% of the S&P 500. So it's not something strong enough to really stabilize if the market does really start to roll over or continue to roll the selling that we've seen recently. Next up here is Xlre. This is the real estate ETF. This one again, this one is actually rolling over, and a very small percentage of SP 500, but this one looks like it's a weak sector. Looks like it's putting in basically an H sell setup. What that means is you have the leg, it's come up and it's starting to roll over, and it's going to end up looking like a huge H. So that is that. Next up we have is Xle. This is the energy ETF. This is by far the weakest sector, comprised of a lot of oil and gas names. As I've said many times, oil and gas is slowly being phased out of existence. Now there will be some industries that do still rely on the use of oil and gas, but it's losing its demand. As simple as that, especially with COVID coming into play, the rise of electric vehicles, all that good stuff. Now, on the flip side of that, because of the rise of electric vehicles, that could actually help the mining and metals, industrials, transportations, all that stuff, because it will be another quote unquote industrial revolution. So we'll see what happens with that going forward. But XLE is extremely weak, and just be careful if you're messing with that. And as always, I like to touch on transportation. Now, transportation has been a major runner, has been leading the market higher, has made a new all-time high, but it looks like it has rejected. Now, this is being led by FedEx, UPS. JB Hunt just reported earnings and didn't do so well and actually started to sell off, which is one of my favorite transportation names, or excuse me, trucking names. But if the market's going to roll, this is going to have a lot to do with it. So as I've said many, many times, I'm a huge believer in Dow theory, and so as transports go, so goes the market. If this starts to roll over, I'm not saying that the economy or businesses or the market is in a tremendous amount of trouble, just that things are stretched. Evaluations are at all-time highs. The market is at all-time highs now. Does that mean it should sell off? Not necessarily, but there's definitely more risk to the downside than the upside to be putting a large amount of money at work here. Now, ideally, from an objective point of view, the best possible spot to be putting a lot of money into the market was down at these levels. Certainly not up here where we're 50% higher. So just keep that in mind going forward. I'm going to be a lot more cautious here with my picks. Like I said, I am still going to hold on to the current long positions that I'm in. Just have to be aware, and a lot of participants don't really take into account the overall scheme of the whole market. So just want to get this video out there. If you like it, if you enjoyed it, if it helped to clarify some things as far as what's going on in the market, feel free to give it a like. I will start doing some of these videos a little bit more frequently. So yeah, that's that. I hope everybody has a very green day. Good luck and have a good day.